In the past, the merger would not have been as value accretive as it is at present. The strategic rationale for the proposed merger is as follows. Over the last few years, there have been certain regulatory changes for banks and NBFCs which have considerably reduced the barriers for a potential merger. In 2020, RBI issued guidelines which laid a roadmap for conversion of large NBFCs with asset size of over rupees 50,000 crores into full-scale commercial banks. This has considerably addressed bottlenecks like semi-urban and rural branching needs. RBI further mandated that within a group, just one entity may be engaged in a specific product line. This would require a reassessment of the group structure. Secondly, RBI has harmonized asset quality reporting between the banks and NBFCs. Thirdly, in addition to the SLR on regulated deposits, HDFC is now also required to maintain a liquidity coverage ratio. Consequently, the gap between the liquidity requirements of a bank and an NBFC have considerably reduced. Also, NBFCs are required to move to a core financial service solution platform, which is akin to the core banking solution of a bank. Scale-based regulations could in due course further harmonize regulations between banks and NBFCs in future. So first is on the regulations. Second is if you look at the CRR SLR requirements for banks, these have reduced considerably over the years to the current level of 22% of the demand and time liabilities. Also, interest rates are significantly lower today as compared to earlier years, and hence the negative carry on raising funds to meet the CRR SLR requirements will be considerably lower today. HDFC currently does not have a priority sector lending requirement, and hence as a part of the combined entity, HDFC Bank would have had to raise funds and increase its PSL requirement through direct lending in the area of agriculture and micro, small, medium enterprises industries. This would have had operational inefficiencies besides resulting in an additional negative carry. This incremental funding would also have carried an additional CRR SLR requirement. RBI has now permitted banks to hold priority sector lending certificates. These certificates are instruments that enable banks to achieve their priority sector lending targets without actually disbursing those loans. HDFC has non-convertible bonds of nearly rupees 80,000 crores, which have an original maturity of over 7 years. Subject to RBI approval, these bonds would qualify as affordable housing bonds and consequently would not carry CRR SLR requirements. Real estate over the years has become an increased level of transparency in regulations. Paramount among these are the Real Estate Regulation Act 2016, the Insolvency and Bankruptcy Code, and many other regulations that have been introduced. This has resulted in an increased level of activity by banks in the real estate sector, both retail and wholesale. Mortgages offered by the combined entity can be widely delivered in an efficient and profitable manner. HDFC will benefit from the lower funding costs of the bank and from its very large distribution franchise, while HDFC Bank will benefit from HDFC's expertise in the real estate space and its low and efficient processing of loans, which has enabled an 8.1% cost-income ratio. The amount invested by HDFC Limited in the capital of HDFC Bank currently has to be reduced from HDFC Limited's Tier 1 capital for computing the capital adequacy. This has a negative impact on the return on equity. And consequently, any future infusion of capital by HDFC Limited into HDFC Bank to maintain its stake at over 20% would have resulted in a further negative drag on HDFC's ROE. As per our estimate, 70% of the customers of HDFC and its subsidiaries do not bank with HDFC Bank, and hence the merger will provide the ability to cross-sell banking products to this very large pool of customers, thereby enhancing the overall business of the combined entity. You will observe from the aforesaid that most bottlenecks of earlier years have been largely addressed, and at this stage the boards of both institutions, after evaluating all options, have decided that this is an opportune time to announce the proposed merger of the two entities for the mutual benefit of all its stakeholders. The proposed merger will consolidate and leverage the significant complementaries of HDFC, the largest housing finance company in India, and HDFC Bank. It will bolster the capital base and balance sheet of HDFC Bank and make it a very large bank even by global standards. The merger is a coming together of equals and will result in mutual benefit to both the institutions and their stakeholders. This strategic merger will bring economies of scale and enable the combined entity to leverage off each other's strengths. The customer will be the biggest beneficiary. It is estimated that as of date, over 70% of HDFC Bank's customers do not have a mortgage. Further, under the combined entity, cross-sell of the group products in insurance, both life and non-life, asset management and pensions will see significant improvement in efficiencies and in profitability. The proposed merger will dovetail the efficiencies of HDFC as a premium mortgage originator with over 45 years of domain expertise in efficient mortgage processing at a significantly attractive cost-income ratio into the lower cost of funds of the bank and its wide distribution capability. Both HDFC and HDFC Bank will continue to operate independently till the effective date so that the mortgage business carries on without any disruption. Let me now quickly explain the structure of the transaction. The transaction involves the amalgamation of HDFC and its two wholly owned subsidiaries, HDFC Holdings and HDFC Investments, with HDFC Bank. HDFC Limited, as you know, is the promoter of HDFC Bank and together with its two subsidiaries currently holds approximately 21% of the share capital of the bank. Post the completion of the merger and subject to regulatory approvals, all the subsidiaries and associate companies of HDFC Limited will be owned by HDFC Bank. Based on valuation by the valuers and the fairness opinion, the share exchange ratio has been determined at 42 equity shares of HDFC Bank of face value of ₹1 per share for every 25 equity shares of HDFC Limited of face value of ₹2 per share. The conclusion of the transaction is subject to regulatory and statutory approvals. Post the effective date, HDFC shareholding of 21% in HDFC Bank will be cancelled, and this will open up a potential legroom of up to 7% of further holding for FPIs in HDFC Bank. The bank has requested RBI for phased compliance in terms of timelines for CRR, SLR, and priority sector lending requirements. The bank has also requested RBI to permit the bank to hold equity in the subsidiaries and associate companies of HDFC Limited. These requests are under consideration by RBI in terms of the letter dated April 1st. The merger will benefit the shareholders of both HDFC and HDFC Bank as follows. Lower cost of funds will be made available for the mortgage business. The bank will have access to the time-tested mortgage origination and loan servicing processes of HDFC. The mortgage business has immense potential, and hence the merger will help the group enhance its market share consequent to further leveraging on the distribution network of HDFC Bank. The merger will mitigate single product risks while at the same time enhance the diversity of assets for the combined entity. Under the bank structure, the features of the mortgage product can be enhanced in terms of product design, in terms of different products which are introduced or which are available in the global market. The combined entity will be in a position to offer the mortgage product seamlessly as against the current arrangement between HDFC and HDFC Bank, wherein the bank sources mortgages and acquires a predetermined percentage of the loan sourced through the assignment route. HDFC Bank currently has 11% of its assets in mortgages. Post the merger, this percentage would increase to over 30% with the potential to grow even higher. The mortgage product will also increase the asset duration of the bank's retail book. Infusion of capital in the bank will no longer be required, and consequently the drag on the return on equity on the mortgage business will go away. Subject to RBI, SEBI, IRDA, and all other regulatory approvals, material subsidiaries and associate companies of HDFC Limited will continue to be owned by HDFC Bank. This will facilitate more efficient cross-selling of banking and financial service products, including insurance and mutual funds. Also, the value of HDFC will not be depressed by the holding company discount insofar as it relates to the shares of the bank. The proposed merger of HDFC Limited and HDFC Bank will therefore lead to significant synergies for the combined entity and will lead to better returns for all stakeholders. The proposed merger will benefit the economy in more ways than one. A larger balance sheet and capital base will allow greater flow of credit into the economy. It will enable underwriting of larger ticket loans, including infrastructure, which is an urgent need of the country. It will enable the delivery of the home loan offering to a large base of over 68 million customers of HDFC Bank in a seamless manner and inter alia improve the pace of credit growth in the economy. HDFC is a significant provider of home loans to lower income group and the middle income group segment under the affordable housing initiatives of the Government of India under the Pradhan Mantri Awas Yojana. Access to housing finance for this category would improve further on account of the low-cost funds available for HDFC Bank. A larger balance sheet will also facilitate flow of a larger quantum of credit into priority sector, including agriculture. Subject to regulatory approvals, HDFC will continue to operate on an as-is basis till the effective date. It's important to note that jobs of each and every HDFC employee will be protected and wherever required roles will be reorganized. It is envisaged that all HDFC branches, offices in India will be retained and mortgages will continue to be offered from these outlets. Over a period of time, these branches could be converted to full-service banking branches. HDFC Sales will be a subsidiary of HDFC Bank, and HDFC Sales currently sources nearly 52% of HDFC's mortgages. The customer will be the biggest beneficiary and will have access to all financial products under one roof. We are confident that the workforce will put in all efforts to make this merger a resounding success. Shashi, you want to say something?
Thank you all. Thank you, Mr. Mistry, for this wonderful opening remarks. I think this is a very historic moment. Obviously, it's still not sunk in, but the proof of the pudding would be how we are able to execute, which is our forte over the next 3 years, and we are very confident for all the remarks that.
तो यहाँ पे के मिस्त्री जो कि CEO VC हैं, वाइस चेयरपर्सन है HDFC लिमिटेड के, वो ये बात बताते हुए कि उनका जो मर्ज हो रहा है HDFC के साथ उससे सिनर्जी आके अच्छी होंगी। उन्होंने एक बहुत इंपॉर्टेंट बात बोली कि अभी तो फुल फ्लैश सर्विसेज के साथ वो रहेंगे, बट आगे चल के इसको और बड़ा किया जाएगा। उन्होंने इस बात की भी बात रखी कि जो FPI है, यानी कि जो फॉरेन पार्टिसिपेंट्स हैं, उनके लिए भी थोड़ा और रूम खोला जाएगा, वो नियर अबाउट 7% होगा और आगे चल के दोनों ही बैंक मिलकर अलग अलग प्रोडक्ट की बेचने के बजाय आप एक ही अम्ब्रेला के अंदर जाके बेचेंगे।